Thank you very much, Rob. Yeah, I seem to, every time I turn up at this conference to speak, I seem to call the bottom of the market. I'm not actually going to do it today because I've kind of got it wrong too many times in the past for reasons which hopefully will become a little bit clear. There we go. So, as Rob says, this is why I'm standing here talking to you. I've done quite a lot of mining finance over the years. I still am. I'm advising 6 or 7 companies at the moment. I've just raised a debt financing of $370 million for managing Providence Diamonds as well. So let's just look back a little bit on the last 12 months and just pause for thought. One of the interesting things about our sector is we're probably, in resources generally, the wider resources sector, the only sector where people invest based principally on where they think the product will be sold. I mean, obviously, in any industry, what price you get for a product is important, but people invest in mining particularly because they think metal prices are going up. They don't necessarily do it because they think we're a really wonderfully well-managed sector, and they can ignore very well-managed companies, even quite profitable companies, because, of course, those share prices valuations are based very much on metal prices. So this is pretty important. And if you look at where we've been just in the last 12 months, I've just pulled out a few of the metals and commodities here, massive drops, really quite shocking. And if you then look one column to the right and see what we've actually done in the last 4 years, since things hit a bit of a peak in 2011, quite extraordinary. And if you think what that would have meant to you as an investor, and probably many of you are investors in the sector, you know, that is a very painful thing to get over and to bring yourself back into. I mean, I've spoken to, you know, career mining entrepreneurs who just wish they'd never even heard of the sector, and all the money they've made has disappeared into the ground, and they're not getting it back. And you know, they wish they'd been in property, and they're investing in property now. So that's kind of painful. I also just looked at the same sort of time periods at a couple of the funds, and also BHP. I could have put on Glencore on here if you feel they're a mining company. They're a substantially trading company to me. Two different funds. Both I'm not naming them, but they're both very large, high-profile funds. One's a diversified fund. One is a gold-based fund. And again, as you can see, they've also been absolutely hammered by the markets, which makes it very difficult. I want to now look at the actual underlying sources of money in this presentation. But you know, the key thing before you get into whether those sources are going to come up with the goods is to think about where it's going next. And I haven't attended all of the presentations for the conference, but I gather there's been a good load of chat about cyclicality. And I put this chart up. Actually, this is, whether you plotted this as a composite metals index, or in fact, as it is, this is the performance of one of the 2 funds I mentioned earlier, the diversified one, you're going to get roughly this chart for you know, where our industry has been. And basically, we had a long period of time of things going up and down in the early days, in the 80s, 90s, very early 2000s, and then of course everything went crazy in this wonderfully called super cycle, which to me was neither super nor cyclical. And you can see it's not cyclical because the cycle is something we all learned at school. It's something vaguely predictable. You can see a certain pattern to it, and people tell me often that we're bottom of the cycle. And I'd love to look at a chart which hasn't been fudged around too much. You could adjust for inflation perhaps, but actually that shows something cyclical. As we just heard from Deepak, you know, there's major events happening in India. Obviously this reflects major events also happening in China, and to a lesser extent the other BRICS, that threw all concepts of cycles out of the window. So I struggle very much with the concept of a cycle. But if you are going to do a cycle, you know, let's draw one on there. Let's all feel happy. Let's have a happy moment. Of course, there's no grounds for this whatsoever because you know, there is no, you know, I can't draw that green line any further back and make it look in any way plausible. If I wanted to be a bit plausible and say, well, look, China was an aberration a wonderful aberration for some people, a rather disastrous for others, because of course it pushed a lot of the costs for most mining companies up through the roof, and then of course sale prices, commodity prices fell away thereafter, leaving them pretty high and dry. But if you pretend it just didn't happen, then you can go and draw a little curve like that, which kind of any of you under the age of 30, I'd suggest that you get another career if this is something that you think is going to happen, because you're going to have a pretty miserable time in mining. I look around the audience, I see not many people under 30, which probably actually says that young people have worked out already that the party may not be looking too good. But I'm not here to depress you. The honest truth is that in all my time of doing this, I've looked at many pieces of commodities research over the years. Unbelievably, 70% of the time, and I used to say 60% of the time, I'd probably even say 80% of the time people actually get it wrong, and these are the people who professionally forecast where prices are going to go, because you just don't know. And that's the real fundamental problem that we're all facing. The sources of money in our industry, and I mean the ultimate sources, not just where you immediately get it from, are of course individuals. The big pension funds, particularly the US pension funds, they back a lot of the funds that you will see in and around the industry, governments, and banks. And I want to just touch on each of these. Let's start with individuals. I'm sorry to the speaker who's following me from the TSX, but the truth of the matter is, and I do talk to a lot of people in all different markets, particularly Canada, certainly obviously London, but it also applies to the ASX and South Africa and wherever else, that the market is very dead, because those guys who put their money into it have lost their shirts. And that includes a lot of contrarians, because if you look at the curves I showed earlier, for the past 4 years the market's been going down. This is a really long and painful amount of time. So people who put their money in 2012, 2013, 2014, thinking they were clever contrarians, and I think being a contrarian is generally a pretty good thing, they've all been burnt. I think we all know, was it Keynes quoted that the market can remain irrational longer than you can remain solvent? It's absolutely true. And these guys, unfortunately, are the people who've been putting money into mining, they're not going to be racing back. But I want to put a little bit of good news, and again, this is a little bit of a sop to my friend who's going to speak after me from the TSX, is there will be a new generation coming through. And just as corporate memory is short, individual memory is short, and these new, younger investors will one day be putting money back into the stock market, but rather like the person I've shown there, is probably a few years yet. So you might have to wait. Which is depressing, because the markets are very important to us. I hope, of course, that I'm being a little bit too gloomy, but I'm not actually seeing any great signs of encouragement from anybody who's involved in those markets at the moment. Okay, so the pension funds are very important sources of money, because this is where the really huge amounts of money come from. I'd love to show you statistics. I don't have the statistics, but if you look at a lot of the funds that you'll be familiar with, and certainly the private equity funds, which are the most important sources of money at the moment, the money substantially comes out of these pension funds, a lot of it out of the US, some of it out of the Middle East as well. And as a private equity is really where it's at. I think there's a couple of funds represented here. This is where the money is. These are the guys who have money and looking to invest it, particularly out of Europe, I'm pleased to say. It's where these have arisen. They're really spoilt for choice. They're not in there trying to replace most of what the TSX or the AIM market was doing. They're looking very selectively and choosing the projects that are really, just going through feasibility study and look good and are in good countries, and they can see cash flow coming soon. And the private equity funds really want to see cash flow. But also there's a lot of money that's come from the pension funds into new credit funds. And this is an interesting aspect to the market for me, especially because I part of what I do at Rockface is very much debt related. But there's a lot of these debt funds that have sprung up. Interestingly, they don't seem to be being run by professional lenders. And I think a lot of them are making some terrible mistakes. I mean, there's two sides of it. One is that they're not making great loans. And I helped a company last year who found themselves with $18 million of debt from one of these funds. The team, by the way, has since shut down. Quite a well-known team, in fact. And they had been lent the money to complete their drilling and feasibility study work. Well, to me, that's not what you should be lending money, or you certainly shouldn't be borrowing it either, unless you want to gamble your company. But I can see there's desperation from a lot of people. That's the only source of money they see. There's a lot of these, particularly in North America. There's some in London now. They're very expensive. If you compare them to the conventional lenders, they're even twice the price. And certainly when I was doing the Mountain Province work, we went out to a lot of these guys. I would say some of them were even 3 times the price, with huge equity kickers as well. And the traditional argument, oh, we're much lighter on terms than all these banks who have extensive documentation. It's a little bit true, but it's not, frankly, substantially true enough to pay 3 times the price for the debt. So I'm watching with interest to see whether a lot of those funds go pop, because I think their lending models are bad, and I think they're not highly competitive, but it's almost like lender of last resort money for a lot of people. And then the other area that where the pension fund money goes in is into royalty funds. I'm sorry, I couldn't find any better picture. But the royalty funds are obviously very important. We see some very large deals being done. And I think the interesting aspect with royalties at the moment is that they are increasingly turning more and more towards sort of debt parameters, equity parameters. They're looking for security, they're looking for kickers, and they're not what I think of as a traditional royalty. And I think they're getting increasingly expensive. But people are desperate for money, and a lot of people are selling their souls, selling all of their upside perhaps, to these royalty funds. Governments got a lot of money, and some of these sovereign wealth funds, particularly see them out of the Middle East, Singapore, Norway, they've got a huge amount that they can invest. Some of it through the specialist funds, but some of it directly. Getting your hands on it, pretty difficult. Yes, that money is occasionally seen, but it's not the thing that most mining companies can go and readily access. So I'm not going to spend a whole lot of time on it. Good luck to anybody who gets money out of them, but it's not particularly easy. So that brings us to banks. Banks traditionally have been lenders, occasionally investors, and certainly when I was at Investec we did quite a lot of investment. But the lenders have had a pretty good kicking of late. They're down, they're not out. Some of them have left the market, but they're more moving in terms of their strategies to much more selective, much more close to home, and by that I mean areas where the bank has lent traditionally a lot before. Interestingly, the French banks are the ones who are really kings of the market at the moment. They're the ones who are really open for business, keen, enthusiastic, and really wanting to do stuff. Hedging, of course, was the traditional reason why a lot of these banks were in the business, because that's where they made all of their money, and not the French banks, all banks. And hedging got quite a sort of dirty name, obviously, as metal prices were going up. Anyone who was hedged was criticised, and chief executives lost their job over it. I didn't actually see a lot of people when the market came off a lot, praising the last few who'd done hedging deals or criticising those that hadn't hedged. It seems to be one of those markets which is sort of asymmetric, and you're a villain if you get it wrong, having done something. But anyway, so hedging does still happen. It isn't quite the business model that it used to be. Also because the banks went through a lot of pain when metal prices went up that they'd hedged. They had massively increasing exposures on a day-by-day basis. And I recall that with great pain, having told the credit committee that given our statistical models, the hedging exposure on the client was unlikely to exceed, say, 30-40 million. And when it reaches 140 million, then we need to ask you what happened to your models. And you have to point to the chart that I showed earlier which represents what a lot of metal prices did, and say, look, this is a bit unusual. We didn't expect the super cycle to hit us quite in this way. So the banks are there, and the fact that I've just managed to close a $370 million deal for a diamond mine, which is actually very difficult to finance, and that's because diamond reserves are generally sort of treated with some level of skepticism by a lot of banks, because it's not like a sort of continuous ore body in the same way that a gold or copper or coal or whatever deposit will be. Diamonds can, your core drilling can show richer deposits than they actually are, or obviously conversely too. So a lot of banks have not been too happy with diamond projects, but we managed to get away, and it was an unincorporated joint venture, which is also a difficult thing. I think the fact is there's actually quite a few bank teams out there who are really looking for business. There isn't a whole load of action going on. There aren't that many mines being built, partly because they haven't got past the sort of equity stage of needing the finance for the final drilling and feasibility work. And so I think some of the lenders are pretty desperate to see something happen, which is good, very good indeed. Right, so let's just turn a little bit to, we talked a bit about availability, but let's also just talk about, let's sort of pull this together for the different phases. Exploration, in my view, well, not in my view, it's generally known, there's absolutely no money out there for people who want to explore. I was talking to a company here earlier who were asking when is the point that the door begins to open for getting finance. It's very difficult. It's probably when you're at the feasibility study stage, and even then you need to show that you've got an exceptionally good project in a good country, in the right metal or commodity, whatever. And then you get a sort of glimmer of hope that people might sort of help you out. To be honest, most companies at the moment are surviving on existing shareholders who don't want to see their investment disappear underneath them. And it's absolutely key if you can get decent shareholders in the good times, because they're the ones who will help you out in the less good times like now. If anyone does offer you debt when you're in the exploration phase, don't take it, because no one should have debt when they have absolutely no foreseeable cash flow. It's really just giving your business away if you want to do that, and if you're that desperate, fine. Otherwise, try and just keep things ticking along is my advice. I'd like to give better news, but I'm afraid that's just exactly where we're at. So when you get to the point of your feasibility study, there's a bit more money available, and particularly from the private equity funds. So you have to have a good asset. Again, I would try and avoid debt at this stage. I referred to my client earlier who raised all that money, confident that they were going to get their feasibility study saying the right result. Who doesn't? I mean, everybody who does a feasibility study believes that it's going to show it to be a wonderful and beautiful project, and no one factors in the fact that a lot of them aren't. It's just statistics. So I would generally cancel against any form of debt products that are being offered out there for that stage, and save it for if you can get it into construction, when everything, the door is absolutely wide open. There's much more funding out there for good projects, and bank debt is out there too. Not a very cheering picture, but I'm afraid that is that's the bottom line. So looking at those in a slightly different way, there's debt there. It's a lender's market. Are the covenants worth it for the cost? I think you have to choose your lenders. I mean, this is now talking to people who are actually going into construction. Choosing your lenders is very important. I can't emphasize that enough. Often people choose local banks local to the country that their project is in. These guys are not professional lenders, and whenever something goes wrong in the mine, which every single mining project deviates from the originally considered theoretical feasibility study, as we all know, those banks then panic and it all gets very difficult. Or if they have another mining deal wrong, they lose faith in the sector, and then you have a nervous bank who wants to get out of the deal, and that's a disaster. Sizing the deal right is very important as well. Don't try and borrow more debt than your project can handle, and that is where getting good advice absolutely matters, because you can easily if you've managed to get through all of those hurdles and barriers that we've just been talking about, and got to the point where you're going to construct your project, and you take the wrong amount of debt from the wrong lenders on the wrong terms, and you don't read those terms carefully, or you don't get advice on those terms more to the point, you are just throwing it all away, and it's a very sad thing, but it does happen. The equity we talked about, I think, through these points. I think one of the interesting, actually the second point we haven't touched on, if your CapEx plan dwarfs your market cap, which there's quite a few people out there in that situation, think about going private, think about talking to the private equity houses. Being listed is not the be-all and end-all. A lot of companies have got into the mindset that you have to be listed and you have to do that. And you talk to the chief executives, just ask them how much time they spend on going round the market, doing regulatory things, spending money on regulatory aspects of being listed. It's a real pain. Going private can be pretty good, and good PE funds know how to look after their management groups as well. It's something that we're doing quite a lot of, because there are plenty of people there with market caps of 10, 20 million, and they've actually got pretty good projects, but it's just going to take 200-300 million to get off the ground. You're not going to get from A to B through the market. It just isn't going to happen. Not in this environment anyway. Maybe in different times you might get taken out. And I haven't really talked about other mining companies taking out, because that to me is more acquisitions rather than financing. But there is definitely an avenue for those sorts of companies to look at the private equity world. And indeed, probably some companies who just fit dead in the water could say they've sold some money by delisting as well, but I'm sure our friend from the TSX is not going to want me to talk too much about that. There's a lot of money in the royalty and streaming world. As I said before, make sure that the terms and the pricing are right. Don't allow it to morph into something it's not supposed to be. Again, getting good advice is vital. You do see companies. I mean, let's think just fundamentally, what is the difference between a royalty and a loan? On a royalty, if you don't do what you said you were going to do, it shouldn't matter. It shouldn't kill you. Not as far as you, the company, are concerned. That's the whole point. You're giving away a lot, and in return, the royalty provider should not have the ability to just bring you down, call default. It's a fundamentally different set of risks to what a lender is taking. A lender does have controls. If you don't build what you're supposed to do and it doesn't go right and it doesn't work out, then lenders have certain rights to enforce security. God forbid it should ever happen, but that's the nature of why debt is supposed to be of that pricing. But if you start taking a royalty and then granting security, my humble opinion, that's mixing different products, and maybe the royalty should be priced quite differently if that is the route that you go down. Again, it comes down to modelling it, it comes down to negotiation, it comes down to working with people who've done it before. So that's what we do. We do provide that advice, help people raise debt, we restructure, we raise royalties, and we're doing quite a lot of work helping people who have very little access to money at the moment, particularly through their normal sources on the stock markets, of meeting funds who actually do have money, but they have to be good projects. We're pretty selective on number 4 as to who we take on. Thank you very much indeed.